What's up? All right, so I wanted to kind of get out of the principal's office and onto the playground because we do this all the time. We're always going to properties. If you guys have my book, How to Create Wealth Through Apartment Buildings, I talk about it all the time. It's one of the 12 mistakes people make is they don't look at enough properties. You got to look at the good, the bad, the ugly. But today we're looking at the good. So this property this is the backside of one of the properties. Didn't want to go all the way through it, but this property is beautiful, beautiful, beautiful. It's a 22 build. It is coming to market, or it's on the market. It has not traded yet. We took a look at it. There's two pieces to it, or two properties in one complex, right? This whole section is two buildings. Well, yeah, two separate properties, the way the developer built it. But to this point, the one we were looking at, there's 240 units, and there's a 277 unit or 274 unit, one of those. But the 240 unit, I love the property, love the location for where it is. This is a high-end location, really is great. There's a couple of little things when we're looking at properties like this to be able to offer on, to be able to underwrite the debt, underwrite the deal, is that one, this property is new. And there's a couple of things like so you guys know, like if you're a fund manager, equity guy, and you are looking to invest, when you're picking a deal, especially from a brand new deal like this, just know that typically anything brand new is going to trade somewhere around 85% occupied, because the developer has to fill that up and then transfer and move their construction loan into permanent financing, and they will not do that unless it hits a certain occupancy, right, which is typically 85% stabilized. So on this deal, we already know that. I think it's 92% occupied, and there were some concessions that are in there, and probably whoever gets it, they're gonna have to let those concessions burn off, because they will really be the first operator. The developer's never the first operator. Their developer, they operate it enough to be able to cash out the existing debt they got to build and any mezzanine or bridge, and then they sell that off, they bring it to market, they sell it to the new buyer. So, but this property is massive, it's pretty. The rents are still affordable for this area. On the other side, if you show, I mean, it'll give away where it's at, but if you show like over there, on the other side of that bridge is one of the most expensive high-end malls in San Diego. And if you spin around and look over this way, on that side, if you can see it, you probably can't see it too good, but if you look at the top of that net over there, that's one of the golf courses, because this is one of the best areas that I love to be able to look at. This Mission Valley, Fashion Mall, Fashion Valley area. This area right here is where all the money's coming. All the money from San Diego, LA, all of it, it all rushes through here, right? So like this property this is a pristine property. Like I know if this thing doesn't trade now, it'll come to market. It'll go through a couple of people that want to get after it, and if it doesn't trade, they'll pull it back, and then they'll come back to market here as soon as the debt market changes, because that's really that's the predicator of any problem right now in this market for properties like that. It's not the asset, it's the debt. And if there's a disruption in debt, it stops those properties from trading at the benchmarks that some of the sellers, which is the developer and or, because it's owned by an institution, right? The institution is a partner on that. That's how that works. So we can walk. So, but I bring this up because I wanted to kind of point it out. Like when you're talking about nicer assets, investing money in deals like this where, it was like, oh, the cash flows, is less. Yeah, it's a long-term play, but that doesn't mean that you can't buy it based on current cash flow and continue to raise the rents, because the average rent over here ranges anywhere from $2,600 to $4,600 depending on where you are in this complex. That is affordable as hell. You got full-blown business centers here. You have all of the amenities, the pools, what else is over here? All the valet type amenities that go along with valet trash and all this other stuff. Man, this thing is awesome. So, I mean, I can ask you too, Bree. Like in 10 years, do you think the rents will probably be $1,000 higher at this location?
Definitely.
Hell, 3 years when the concessions burn off. As a matter of fact, I know for a fact, because we talked to somebody who lived here that were paying $3,600 a month, and their lease was coming up, and they were getting ready to start paying $4,200 a month, and they were like, "We love it here. We're gonna stay." So that I already understand all these things are happening. So when a lot of times when people are thinking that, oh, what if you're overpaying, or what if you're looking at assets that aren't in line with what you're doing for the fund, you're like, look, if you think about things where they are today, if they make sense today, they're 100% are going to make sense 10 years from now, because we're playing the rent increase game on nice assets where we know we can just take our money and store that money, and it'll be there and it cannot be destroyed. Do you ever think this thing will be knocked down again? This thing's irreplaceable.
Yeah, definitely.
you couldn't build this again for the price that they did it. And when this thing trades, guaranteed, it's going to trade for less than construction cost, less than price per door that it take to build. So it'll be under replacement cost. It'll probably be less than purchase, less than the asking price. And let's just say, for simple math, you were to raise rents on this thing $100 a unit every year for the next 10 years. That's $1,000 more a door. Man, guaranteed you're going to double or triple the equity that we had in this deal. On a deal like this, you'd have a trophy asset in a trophy location. It's nuts. It's crazy. So, but I wanted to show you guys and kind of go over a couple of things that when we're looking at a deal, the things that I run through in my mind to just give you an idea of assets. All right. So, I'll make a couple more videos like this, like me and Brashan are going to be out and about looking at assets and stuff like that. So if you're an investor, you're interested in having a conversation with us, go ahead. You can go to bell-capital.com, and you can only do two things on that site. You can schedule a call to talk with us directly, or you can hit invest now or get started, and it'll take you to the portal, and you can review everything that we have there, what's going on, how it works to work with us. And if you still have questions because you have a personal situation, we want to talk to you. I built this so we can actually talk to our investors. All right. So that, or you can text us. You can text 808-778-1326. Just text deal, and one of us will give you a call back, answer any questions you have, because we want to talk to you personally. All right. So like this video, share this video, subscribe to my YouTube channel. We're trying to get more subscribers here. Give it a thumbs down if you hate it. Don't be a hater and a hider at the same time. But for real, look at this thing, man. That thing is beautiful. This property, like you ain't gonna get better assets than this over time, guaranteed. I mean, it's a once in a lifetime opportunity that's happening. So don't miss it. All right, let's guys talk soon. Bye.